Hi there, this is Jim Duffy with MortgageLenderAtlanta.com. That's my blog. If you've been there, great. If you haven't, I encourage you to take a look. I get questioned a lot for people wanting to take out a mortgage, wanting to buy their home. What's the difference between paying points versus not paying points versus no closing cost loan? And more specifically, I get asked, why in the world would anybody pay points who's in their right mind? And secondly, I get asked, how in the world can lenders do a no closing cost loan? And if they can do it, why don't they do it in every case? Well, I'm going to tell you that right now. We're going to go through a couple scenarios. Let me zoom out here real quick. This is a good faith estimate that I prepared. It's a sample good faith, and the sample says we're making assumptions. We're buying a $300,000 home in this case. We're financing 90% of that, and that means we're putting a 10% down payment, or $30,000. Oops, let me go over here to standard closing costs. And right now rates are about 5% for a 30-year fixed rate. Slightly better than that, but for our comparison's sake, they're going to be 5%. As you know, for the last 9 months, you've been watching the news, I'm sure, rates have been floating between 4.5% and 5.5% with some standard closing costs. Let's go down here to closing costs and see what the differences would be between the different types. First of all, we're going to go through standard closing costs. And with that, I charge a 1% origination fee. Most lenders do. 1% is 1% of the loan amount, whatever that may be. That's how I make my money, split it with the company, pay Uncle Sam, but generally speaking, keep a profit so we can stay in business. The rest of the fees are standard fees, just costs of doing business basically. You've got your doc prep or processing fee, you've got your tax service, underwriting. This is not the place to go through the fees, but then you have your attorney fees, your state taxes, particular to each state, of course. And closing costs in this case are about $6,500. On top of that, you're going to have an escrow account which you're setting up, and your escrow account is going to be about $3,500. Taxes, your property taxes, your homeowner's insurance for the first year, you're going to escrow 2 or 3 months on top of that, interim interest. So all told, about $3,500. Now come on over here to cash required for closing. Let's zoom into that for a minute. Again, $300,000 purchase price. Here's your closing cost of $6,500. Oops, there's your prepaids of $3,500. So total is $310. You subtract from that your loan amount of 90% of the purchase price, or $270. I've given you credit for $1,000 earnest money in this case, but what I haven't given you credit for is any seller paid closing costs. That's important because right now we are in a buyer's market, and the buyers are paying all or most of the closing costs on most every contract I see coming across, which means you can afford to do this closing cost loan as opposed to no closing costs. What's that look like? Well, let's take a look. Means cash to close, including your down payment of 10%, plus your closing costs, plus your escrows. Total cash to close is going to be about $39,000. Plus your earnest money will be about $40,000. But again, for comparison's sake, there we are. Let's go to, I'm going to skip over low closing cost loans. I'm going to go straight to no closing cost loans. And in this case, same assumptions for a no closing cost loan. We've got $300,000 purchase price, we've got 10% down. The big difference is in the interest rate. No closing cost loans, generally speaking, are about half point higher than a standard or par rate. And what that is, it's the inverse of costing discount. You know, as you pay discount points, you go down in rate. As you get yield, in this case, we go up in rate. About half a point, generally speaking, gives me enough yield to pay your closing costs for you and still make a bit of a profit. So let's go out from here and look at the closing costs. Notice I have not charged an origination nor discount points. All the rest of the closing costs are standard, so it equals $3,800. But here's where that comes into play. Cash required to close. On this sheet, I'm going to show you that $3,800 is being paid by me, the lender, for you. Because again, I have enough yield by increasing that interest rate to pay all your closing costs for you. So your total cash to close is basically your down payment, sorry about that, your down payment plus some escrows. But that's it. So your cash to close went from $39,000 to $32,500. Real quickly, let's take a look at paying points. Same assumptions, of course. $300,000 purchase price, 10% down. Your interest rate, 1 point is 1% of the loan amount. Whatever that loan amount is, just 1% of that is a point. And a point, rule of thumb, a point buys your rate down by 1/4 point in interest over the life of the loan. For all 30 years, your rate will never go up from that 1/4 point discount that you've just bought down. Let's scroll out. Now you can imagine what's going to happen here on your closing costs. Your closing costs went up, and the reason they went up is because we've added a discount point, 1%. So your total closing costs in this case went from $6,500 to $9,200. And likewise, your cash to close, let's scroll out here a little bit, your cash to close went up as well, as you can see. So you went from $39,000 with standard closing costs to $41,675 if we round up. Again, giving no credit for seller pays or anything of that nature. Let's compare. This is where it tells the difference, and your lender, your mortgage lender, will be able to do this for you. In the first case, we've got a 5% rate. Second case with no closing cost loans, a 1/2 point higher, and if you're paying a discount point, it's about a 1/4 point lower than that. Now, the lower the rate, the higher the cost to get that rate. In this case, with down payment and everything, it's about let's compare closing costs. Total closing costs is about $9,200 as compared to $0, as compared to about $6,500 for a standard closing costs. The inverse of closing costs is true for the payment, obviously, because your interest rate is lower the higher those costs you just paid. In this case, paying a discount point, getting that 4.75% rate right up here, your payment's going to be about $1,838 a month, as compared to a no closing cost loan, which is $1,963. What is that, about $1,025 difference roughly? About $1,025 difference per month difference in payment. That can make a big difference. And your standard closing costs about $1,880. Here's the difference. Rule of thumb: when do you choose a no closing cost loan? When do you pay points? When do you do none of the above and just do the standard closing costs? If you're refinancing and you're going to save a significant amount in interest without paying closing costs, letting the lender pay the closing costs for you, do so. Why? Because you keep that equity in your home in that case. Why eat up the equity if you're still going to benefit from those savings? That's a big time when you do that. Otherwise, if you're buying a house, getting a great deal but the seller's paying no closing costs at all, well, you might consider lender paid closing costs in that case. That could benefit you. When do you pay points? When you're nuts? No, not really. Contrary to popular belief, there are a couple occasions where points do make sense. One occasion, for example, if you know you're going to be in that home for a long time, rates are as low as they are right now, they're not getting any lower. If they do, they're not significant enough to benefit from refinancing. It may make sense to pay points. I'm still not a huge fan of it. I'd rather do the 5% with no points, unless the seller is paying enough in closing costs to pay that point for you. Then definitely take advantage of it. When else? The only other time I've really done points is when someone's retired on fixed income and the only thing that fits in their budget is $1,838 a month in this case. $1,900 is too much, it's blowing their budget. Alright, I've done points in that case. I've suggested points because you want to make sure that house is always affordable on that fixed income. Otherwise, just not a big fan of points personally. Can't say I'm a big fan ever. So those are pretty much the cases where you do a no closing cost loan as opposed to paying points, as opposed to just your standard 30-year fixed standard fees. I hope that's been useful to you. Again, my name is Jim Duffy. My blog is mortgagelenderatlanta.com, and I hope you come visit us soon, and I hope you found this useful. Thank you.